All right, yes guys, welcome back to another YouTube video. All right, in today's video, we're gonna be going over the ICT silver bullet strategy. So we're literally gonna be going over every single thing that you need to know, including my A+ checklist and entry criteria. We're gonna be providing you a full risk management plan. We're also gonna be going over daily bias and how to align the lower time frame with the higher time frame. And then towards the end of the video, we'll also be going over some live trading examples so you guys can better understand this strategy. So stay tuned for that and let's jump straight into it. All right, so let's start off with the definition. All right, what even is the ICT silver bullet strategy in the first place? All right, so for anyone new here, the ICT silver bullet strategy refers to a high probability intraday reversal setup that typically occurs during a very strict 30-minute time window. So what does that mean? Usually every single day inside of the New York session, you'll get one golden opportunity, which will be referred to as the ICT silver bullet. And that's exactly what I'm gonna be teaching you in today's video. All right, so here we have the A+ checklist criteria. All right, what does the silver bullet even include, right? Number one is gonna be a sweep of liquidity. So you're looking for either a sweep of buy side liquidity or sell side liquidity. Now, if you wanna get more technical, you wanna understand better what is high probability and what is low probability. If we sweep London highs, for example, that's gonna be 10 times better. So look out for session liquidity also. Another good one is Asia highs and Asia lows. But that is number one on your checklist. What you should be looking out for, guys, okay, is a sweep of liquidity, either buy side or sell side. If we sweep London or Asia, even better, okay? That's number one. Number two comes displacement. So after we sweep liquidity, we want to see price displaced in the opposing direction. So if we've just swept buy side liquidity, for example, now we want to see a aggressive displacement lower in the opposing direction, okay? Same if we swept sell side liquidity, we would want to see a displacement higher aggressively in the opposing direction. Number three is going to be a market structure shift. So usually what comes with displacement is a market structure shift. So let's say we've just swept sell side liquidity, for example, we want to see price displace above a swing high. Once we break that swing high and we have a body closure above that level, that is then considered a valid market structure shift. Now, if price doesn't have that body closure above that swing high, yes, the trade could still be valid. However, it's going to be 10 times lower probability compared to if we actually closed above. Again, this is going to be the opposite way around if we swept buy side liquidity. All right, we want to see a break below a swing low, all right? Now this leads on to number four, is gonna be a fair value gap. So this is our entry model. It's a 3-candle formation. In a bullish example, all right, it will be the first candle's wick high to the third candle's wick low, all right? And usually that second candle will be the displacement candle. So the difference between that first candle's wick high and the third candle's wick low, that will be your inefficiency there, what we call a fair value gap. All right, and then you have your entry, all right? So as soon as price taps into that fair value gap, you enter either long or short, depending on the direction of the trade. And this is very, very important, guys, all right? You wanna make sure that your entry is inside of the specific 30-minute time window, which we know as the 9:45 to 10:15 a.m. macro, all right? This is all in New York time, so make sure your trading view chart is set on that specific setting. So once you have your entry, all right, next comes the stop loss. So you either want to have your stop loss above a swing high or below the swing low. Again, depends on the direction that you're trading, but the maximum amount of risk in handles that you're gonna be risking, specifically on NASDAQ we're trading, is gonna be 30 handles. All right, and once you have all of that, guys, okay, we've swept liquidity, we've displaced, we've had a market structure shift, we've had a fair value gap, we've had a clear entry inside of the macro, we have a valid and clear stop loss, okay? We're risking the correct amount of handles. The last and final step of this strategy is you wanna target the opposing liquidity. So this can either be buy side, sell side, London highs, Asia lows, relatively equal highs, relatively equal lows, okay? You need to find a specific draw on liquidity where you believe the market is gonna head to inside of that current day and then target that area, okay? Because usually when we have, for example, relatively equal highs or equal lows in the market, they don't tend to stay like that for a very long time. And price will act as a magnet when drawing to these areas. The importance of the higher time frame, okay? Now, you wanna make sure that the lower time frame is aligning with the higher time frame. So what does that even mean? If your daily bias is bullish, guys, okay? For example, we're inside of a daily bullish fair value gap, which we have clearly respected and that are very clean, relatively equal highs just resting above, okay? Then your bias is definitely gonna be bullish. This means that you wanna find a lower time frame entry that also aligns with the higher time frame bias and is also bullish, right? So If you see a bearish setup, guys, on the lower time frame and it's not aligning with the higher time frame, are you going to be taking that trade? Absolutely not, okay? You want to be only taking trades that align with the higher time frame, because that is when the trade is going to be the highest probability of actually working out. Whenever the lower time frame aligns with the higher time frame bias and the drawn liquidity, that is when your trade is very smooth and usually just runs to TP effortlessly, okay? If you start trading against the daily bias and against the higher time frame draw, your trade's gonna be very, very risky, and it's most likely gonna go against you. It's gonna be like an aggressive dog on a leash, all right? It's not gonna just flow with the draw, it will go against you and it'll be very, very hard, okay? So most of the time, yes, there are some times where it can work out, but it's gonna be very, very risky, and I would not recommend it at all, okay? The higher time frame always fades the lower time frame, remember that. Where to take partial profits. A lot of people struggle with this. With this specific strategy, okay, you're gonna be taking your partial profits at internal range liquidity. So to give you guys an example, a unfilled fair value gap resting either inside of a premium or a discount, this could be your first target where you can take something off your position and reward yourself, reduce risk, etc. So how would you even figure out if price is in a premium or discount? You'd measure from the swing high to the swing low with your fib tool on TradingView. You'd find 50% of that current price range, okay? Anything above 50% is gonna be considered a premium. Anything below 50% is gonna be considered a discount. Usually, if you see a fair value gap that has not yet been rebalanced, either sitting in a premium or a discount, that's gonna be a very, very good target as your first TP area, or where you take partial profits. Another good area where to take partial profits is internal buy side or sell side liquidity, resting inside of the current price range. So if you see buy side in a premium or sell side in a discount, meaning resting below that 50% level and is inside of the range, this could also act as your partial area, okay? So anything outside of the price range will count as external range liquidity. That's where you should be closing and exiting your full position. Anything inside of the price range is going to be considered as your internal range liquidity. That's where you take something off, you don't close your full position. External, you close fully. All right, hopefully that makes sense. Okay, this one is very, very important, guys. Very, very important. And a lot of people on YouTube, a lot of traders out there, they tend to forget and they don't really mention a lot about this. When it comes to this specific strategy and when you're trading the indices market, which we are, okay, we trade the NASDAQ with this strategy. So you also have to look at the correlating assets or pairs, okay? So in this case, is going to be the S&P 500, which we know as ES, okay? So it's very important that both of these assets are correlated, meaning you see the exact same price action on both pairs. If we've displaced on NQ, for example, right, we've swept liquidity, we've displaced, we've had a market structure shift, everything looks very, very clean, but on ES, there's another story, right? There's no fair value gap, for example. Are you going to be taking that trade? Absolutely not, because ES is the main mover in the indices market, and usually tends to be the cleaner pair. So if ES has no fair value gap, no entry model, then you should not be taking that entry model on NQ, because 9 times out of 10 is gonna be a trap and we're most likely gonna get stopped out on that trade. If it's the other way round, where ES has the fair value gap but NQ doesn't, you can enter based off ES's price action on NQ off a different PD array. Now this gets a little bit more technical and trickier. I've not really explained this on YouTube ever before, but it is a very good tip that you guys can use, all right? So whenever you're trading this model, always, okay, make sure that you have your screen split in half, okay? So one side you're looking at NQ, the other side you're looking at ES, okay? For the best and cleanest trades, you want to have both of these assets with very similar price action, okay? So if ES has one thing, NQ has to have that as well, okay? Because if it doesn't, it's most likely going to stop you out. Now, you can also pair this with SMTs, for example. So if NQ doesn't take a low and ES does, then you have that bullish SMT, which is also good. But that's kind of the main reason why you're going to be looking at both pairs. All right, so also one thing that I forgot to mention is, of course, the time frame and what session we trade this exact model. So the session that you want to be trading is going to be New York session. When you do your analysis, guys, obviously when you mark out your buy side, sell side liquidity, you're going to be doing all of that on the 15-minute time frame, all right? And then the entries should be anywhere from the 1 minute to the 5-minute max, okay? Please, please, please do not be entering on the 15-minute time frame, all right? Use that time frame to analyze and mark out your levels, but your entry should always be preferably and ideally on the 1 minute time frame. That's the cleanest time frame for this specific strategy, but you can also enter on the 2 minute, the 3 minute, the 4 minute, and the 5 minute maximum. All right, the higher you go, the harder it gets to have a valid stop loss. Okay, so usually on the 5 minute time frame, sometimes you will get a valid stop loss of 30 handles, but most of the time your stop loss is going to be invalid and you're risking way too much. All right, so now let's go over risk management. This is very, very important when you're trading the strategy and when you're trading any strategy. Okay, risk management is very important because you don't want to be blowing your accounts. Okay, so I've given you 2 examples. We're going to be doing a 50K account. You want to start off risking 10 micros on a 50K account. Okay, if you take a loss, you reduce your risk and you go down to 5 micros, right? And you stay at 5 micros until you get that win again. Once you get that win, only then you can increase your risk back up to that original 10 micros, okay? If you take another loss on 5 micros, you simply just stay at 5 micros until you get that next win again, and only then you increase your risk back up to 10 micros. So that will help you from blowing your account quickly, okay? Because when you do take a loss, you're actually stepping back, you're reducing risk, and you're not increasing risk and stepping forward. Okay, that's what most people do. They'll take a loss, they'll get very angry, they'll revenge trade, and they'll put even more size on, and then that will result in them blowing their account. Okay, so that's definitely not something that you want to do. Okay, I've done all of that, guys, and trust me, it doesn't work. You need risk management in order to actually become profitable with trading. Okay, now another approach, what you can do is you can buy yourself a 50K top step account, consistently risk 5 micros, okay, without halving your position. So you can either start with 10 micros, take a loss, go down to 5, or you can just risk 5 micros consistently and don't halve your position. But yeah, we've literally covered every single thing that I could think of, guys. We've went over the A+ entry checklist and criteria, what to look out for when you're trading this model. We've gone over risk management. We've gone over how to align the lower time frame with the higher time frame bias and drawn liquidity, asset correlation, what time frame you should be entering on, and which time frame you should be analyzing your charts on. So now we're gonna be jumping into the live trading markets, and we're gonna be showcasing you a few trading examples of this specific strategy so you guys can get a better feel and understanding of what you're actually looking for on the chart. So let's jump straight into that. All right, guys, so here we have a very clean bullish example of the silver bullet. So number one, what are we looking for? We're looking for a sweep of liquidity on the 15-minute time frame. So we have this level down here, all right, which will act as our sell side level, all right? So we're looking for price to come down and sweep this level. Price came down, we swept that level, and now we're looking for a displacement higher that is paired with a market structure shift. So price came up, it has displaced and is broken above that swing high. However, we have a fair value gap here. Now, this is very important. The entry has to be inside of that specific 30-minute time window. Is it inside of there? No, it's not. So we're gonna mark out the 9:45 to 10:15 macro on our chart, and we're going to ignore all of this mess and simply wait for price to give us an entry inside of the macro. So as you can see now, we are inside of the macro. We've clearly swept liquidity, right? We've also displaced even further. We've broken above a swing high, and we've actually had a body candle closure above that swing high, meaning this is a more significant market structure shift. So what are we looking for next? We're looking for a fair value gap, which will act as our entry model, and then we can enter based off that. So there's many fair value gaps inside this price leg here. Now, which one are you going to choose? Okay, I always recommend to choose the first fair value gap. If you can have a valid stop loss of 30 handles, then I'd always recommend choosing that first gap. Your entry would be there, stop loss below a swing low, which in this case would be this one. This candle has also rebalanced both inefficiencies already. So realistically, price should not be going below that low. So as you can see here, we're risking around 18 handles on this trade. And as soon as the macro hits at 9:45, you can see this candle here, you'd be entering straight away inside of that gap. Final step, okay, target the opposing liquidity, which in this case is going to be buy side liquidity. Now, as you can see here, this is a very good example, right, of external and internal range liquidity. This is our price range here, okay? So what I like to do, I take out my fib retracement tool. I'm measuring from the swing high to the swing low, okay? This is now my most recent and current price range, okay? Anything below 50% is a discount. Anything above 50% is a premium. So where are we gonna be taking partials on this chart? Pause the video here and comment in the comment section down below, which area are you gonna be taking partials at? All right, guys, so hopefully you have done that. That is a learning opportunity, because if you do get the answer correct, then obviously you know you have a good understanding of this strategy. So the first area where I take partial profits is definitely going to be this fair value gap here. So going back to the PowerPoint, where to take partials, all right, measure from swing high to swing low, find 50% of the range, find the first unfilled fair value gap sitting in the premium, okay? So this gap here, it has not been rebalanced, okay? Price has not yet tapped into it. So this is gonna act as our target or partial area where we take a little bit of our position off, reduce the risk, and ride the rest to external range liquidity, meaning outside of the range. So let's see how this trade will play out. Okay, there you go. That would have been your TP1 smashed. You would have closed some of your position off. At this point, you can set your stops to break even and ride the rest towards external liquidity. So let's see if we get that final TP. Yes, we do. Final TP smashed. And this is a very, very clean example of the ICT silver bullet strategy. Okay, so notice how we had our entry inside of that specific macro 30-minute time window, and price even came back down and gave us another entry, okay? So there was multiple entries on this trade, and we literally had everything that we needed to see, okay? We swept liquidity, we displaced, market structure shift, fair value gap, we had a nice area to take partials, and a very clean draw on liquidity towards that external buy side liquidity. So I really hope this makes sense, guys, and I really, really hope that you got some sort of value and information out of this video. I've tried to explain it the best way I possibly can. Now, I literally do the exact same thing on live stream every single day at 9:30 a.m. New York time, okay? I trade live with my live trading community where we take trades exactly like this one here. So if you are someone that's been struggling with trading ICT concepts and you want to get to that next level, but you need someone to watch to explain the reasoning behind that trade, right? Not only am I just giving you guys a signal or telling you where to buy and sell, I'm actually explaining the trade, why I'm taking it in the first place, why it worked out, why it didn't work out. You guys get to listen to my full thought process when I'm actually inside of a live trade. So if that's something that you'd be interested in, make sure to go check out the links in the description. But that's gonna be me done for today's video. If you have enjoyed, please leave a like, leave a comment, share, and subscribe. And I'll see you lot in the next one, guys. Take it easy.